Morning, everybody. We're just going to get started in a minute. Just give it another 30 seconds for everyone to join the webinar. While we're getting started, I'll share the disclaimer, which is important to our compliance departments. Always like us to share these informations. Okay. Thank you, everybody, for joining us for the year-end crypto webinar. We wanted to take a minute to really step back and reflect on the year that sort of passed, but more importantly, talk a little bit about so the evolution of the space in crypto, what's been happening, and where we're going over the next number of years as we enter 2024 specifically. We've had a pretty exciting year in terms of 2023. And we thought it would be important to kind of share some thoughts on what's occurred, how we've gotten here, and more importantly, what sort of the different factors that are driving the markets, not only through this year, but as we enter into the year ahead. There's a lot of information, a lot of noise, and a lot of details, and that are sort of popping up and different pieces of information. And it's important to have a really clear understanding of the details. Today, we're going to be joined. So first off, my name is Sam Seif. I'm founder and CEO of Purpose, and really proud and excited to share a lot of content today. Today, we're going to be joined with Tyler and Cameron Winklevoss. Cameron and Tyler are actually key partners of ours on the custody side of the business. They are co-founders of a company called Gemini, which is a global crypto and Web3 platform that offers a wide range of crypto products and services for individuals and institutions across and around the world. They are one of our core custodians for our crypto ETFs at Purpose, and have had a really strong and long-term working relationship with the organization. The Winklevoss brothers also are principals of Winklevoss Capital, which is a private investment firm that focuses on investing in early-stage technology startups. And they've been angel investors and entrepreneurs in emerging technologies really for the last 20 years. And they were well known as early investors and advocates for Bitcoin, and launched Gemini in 2015 as an infrastructure and institutional platform for the space, as they recognized the need for institutionalization for the back end and the infrastructure to support the industry as it evolved. And then prior to starting the business, actually Cameron and Tyler were both members of the U.S. men's national rowing team. They have both graduated from Harvard University and also have their MBA from the Said Business School from Oxford University. And they've represented the United States at the 2008 Olympic Games in Beijing in China, and they placing 6th in the men's pair event. So we're glad to have Tyler and Cameron on with me today. They're going to be joining shortly as we go through the discussion today. We're going to have a good opportunity to kind of leverage their knowledge and intelligence and what's going on. As we sort of, kind of get started here, I wanted to maybe give you a little bit of perspective, first and foremost, on what's been going on. And first, Purpose, we've been in the space for a number of years, both for two important principles. So today we are the largest ETF manufacturer of crypto products in the world. We're very proud of the products that we've built over the last number of years and the legitimacy of what they've done, both in our BTCC, which is our Bitcoin ETF, and our ETHH, which is our Ether ETF, and then of course the yield versions of those, BTCY and ETHY, which combined represent over $2.5 billion in capital. But one of the things that's really important is that we have sort of two components of the conversation. The first is, we launched these products, because we felt that the market needed a safe, secure, and low agency way for individuals to participate in the crypto ecosystem and to get access to crypto in a really unique way. And then second is we also had a deep thesis. We had a deep thesis on the space, and we've had one for a long time, and we felt that it was really important to allow investors who had a thesis in the space to have an easy way to articulate that. And so, as we talk today, we're going to talk a little bit about both of those components. So the importance of the infrastructure, the importance of access, the importance of call it low agency, and what I mean by low agency is low friction ways to own the asset, and then also security and safety, which is a really important component. And then we'll also spend a lot of time on the sort of thesis to the asset. Why is crypto? Why is Bitcoin? Why is Ethereum? Why is the space exciting? And what I encourage every single one of you to do is, if you haven't already, is to take the time to pay attention and build your own thesis. Whether you are an individual who understands the value, that understands the technology, understands what these can ultimately represent, or are curious, it's really important that you develop your own perspective on what it is that is represented here and why crypto is either exciting or not exciting. And many people, of course, around society have their own opinions. A lot of people like to vocalize those publicly. Our view has always been, and my view has always been, if you're going to vocalize things, you should really get into the depth and understand it, so you have a deep understanding of why these assets are relevant or not. So I think I saw Tyler join a second ago, and I think they're going to join when they are on, and we'll get them involved. So first and foremost, on sort of the review, year in review, and if Tyler or Cameron are on, please just jump on whenever you are, and we'll get you involved as soon as we get going. Year in review. I think it's important to sort of look back at the last year, of course, the last couple of years, and look at what's gone on within crypto. And I think I always like to look at a bigger perspective. So, crypto is a space that really, is still early and young. It was developed in the sort of coming out of the financial crisis, as everyone knows, 2008, 2009, as a idea to really decentralize the way that value is transacted between one party and another party. As you know, what we call that is the agency between transactions. And so, most of or all of society today generally is transacted within high agency, meaning that there's usually a broker or somebody in between two parties when they want to transact. And crypto and Bitcoin specifically was built on this principle of, what if we could develop a trust structure that ultimately did not require you to build agency between two parties, and so that ultimately party A and party B could transact directly and do that in a very high trust way. And so that was the principles behind it. And of course, it sort of created this whole unique and exciting vision for the future of call it general value exchange. And we've seen this amazing kind of breakout of crypto as a principle. And what's happened in the last sort of 15 years since the original white paper on Bitcoin has been that many people have started to look at it and build their own, call it innovations, in their own ideations of what this ultimately could be. But the foundations are really important to understand. And so, first and foremost, it's a young space. It is still developing. It's still figuring out its footing. It's still figuring out what it ultimately could be. But the foundations of why it's relevant are very, very real. And as you think about the next 10, 20, 100 years of society, and you think about the way that technology is evolving, both from the internet to AI, you start to think about how this technology, the blockchain and tokenization technology, will become extremely relevant to enable transaction value to occur in a high trust or low trust environment. So when you think about that, it's really important. And so when you sort of take that from the sort of how this space has evolved, it's no question that we've seen a lot of volatility. We've seen a lot of development, and with development, any sort of new era, you see a lot of players that come that may be less scrupulous, less beneficial use cases, all those things that occur in any sort of new technology. And I think it's really important to recognize that. So why I say that is, as you think about the space and you see all the noise that's going on around us, you have to be able to cut through the noise and really focus on what's at the heart of it. And of course, at the heart of it, we've seen a really exciting foundational principle of technology and value principle that continues to evolve on a global scale. And one of the things that, of course, is important is this is an asset that gets priced every single day. So you have a unique technology with lots of noise, and you have pricing every single day. So what does that cause? It causes a lot of sentiment, both positive and negative, that you see in the daily prices, and you see a lot of impact on that. So, of course, 2023, 2022, 2021 were years where you saw lots of sentiment. One things that I care deeply about is, as you think about the sentiment comes and goes. And it goes, there's times when people are extremely excited about the space. There's times that the space is actually out of favor. But what's happening at the core? What's happening at the foundation? And that's what we really care about. So 2023, when we look back, we saw a lot of really continued foundational principles that are evolving in the space. So the core back, utilization of the technology, the value proposition of the technology beyond the sentiment has actually been growing. So first off, Tyler, I want to just thank you for joining. Welcome, and appreciate you being on. I've given an introduction already of you and your brother as well, so appreciate you trying to make it here. We're just kicking off. I'm really going through the 2023 in review, and so I'd love you to pipe in as I go along and add some color, and I'll ask you some questions as we go along. So first off, we've had a really positive 2023, both on the sentiment side and the market price, and that's coming off of a very difficult 2022. But that's sort of what we've seen in the space. If you actually flip, Mark, if you can share the slide that shows sort of historical prices, this is a really interesting thing. So, sorry, previous slide. This is the sort of looking annual returns of asset categories. And you can see here, the returns of Bitcoin have been pretty spectacular in certain years. And then, of course, pretty disastrous in other years. So if you look at the returns of 2022 and 2018, you'd think that Bitcoin was an awful asset. But if you look at it in the compounding effect of what's gone on, through the mid 2010s, and of course in the last year, and through the 2019 to 2021 period, Bitcoin has been an asset that continues to see significant value appreciation. And what that is that a new technology, new area, sentiment increasing, but foundational sentiment also increasing. So yes, you have the market, call it frothiness sentiment, but you also have this foundational sentiment that is driving into the asset as people become more aware of it, become more, build their own theses, and more importantly, also start to build an understanding of why they like it, and also the access points become less friction. And so that's a really important thing. And so 2023 has been a big year, of course, over 100% returns in crypto broadly. Bitcoin, and Ethereum have been, seen really strong returns, Ether just under 90%, Bitcoin just over 120%. And, what we've also seen is that the more core areas of the space, so the sort of more higher quality crypto assets, have been the areas that you've seen greater appreciation. That's the really important difference, because in some of these different periods, we've seen crypto that was less legitimate actually providing greater returns, and that creates a lot of, call it, sentiment changes as well, and disastrous outcomes for some investors. On top of that, we saw some really important regulatory changes. So 2023, we saw positive regulatory advancement. And for many people in a decentralized asset, you'd say regulation's bad. But in fact, regulation actually is really important. And it's important because what it does is it builds the foundations of infrastructure and, call it, oversight that are critical to any asset category. And so, of course, in the United States, we saw a little bit more clarity. And I know Tyler will probably have a lot more depth on this one. A little more clarity on what's going on and how they're going to look at crypto. And I think it's sort of built through the year, especially some of the different actors and players pushing the regulators to create clarity. But more importantly, we also saw settlements around really important cases. So the FTX case resolution, sort of movement towards a resolution, is really critical. Binance, the settlement on that was a really critical step in the industry, because what it allows for is, as you sort of see these sort of changes, the regulators can now start to legitimize the asset when you have the overhang of historical cases kind of coming to bear. In Europe, we saw, the EU lawmakers passed a vote to implement sort of a regulation around what they call the markets and crypto asset regulation, which sort of states that crypto exchanges and custodial wallets have to be licensed. And the token issuers must, follow a certain set of, call it, requirements, and for their white papers, for the transparency, for the reserves. And by the way, this is a really good thing. And so legitimization through regulation is a really good thing for advancing an industry. I'll stop here, and I wouldn't mind Tyler's perspective on this, because I mean, you're probably deeply involved in this. And Tyler, how have you seen, coming in the United States specifically, some of the changes from a regulatory clarity perspective? And I know it's probably started with a very frustrating part of the year, and as you sort of entered the end of the year.
Yeah, no, thanks for having me, Sam, and great sort of lay up into this question. It feels like we're getting to more regulatory clarity in the US in terms of Bitcoin. I think that everyone unanimously believes that Bitcoin is a commodity, including the SEC. So that's nice, but there is still some murkiness on other assets that are being adjudicated in the courts. So the Ripple case versus the SEC, and unfortunately, without great rulemaking, it just takes time to get to that clarity. But as you said, there's across the globe, Europe's making great strides towards more clarity in other jurisdictions. So it's happening. It's just going to take some time. But ultimately, our thesis the whole time has been that thoughtful regulation breeds the best innovation and consumer protection. And so the healthiest markets strike that balance, that tension between the right amount of regulation, not too much, but not too little, that really fosters an explosion of great growth and innovation, but also the right protections for consumers. So we've been strong advocates for this for close to a decade, and it's great to see that happening over time.
Yeah, and I think we agree with that. And Tyler, I mean, in Canada, one of the lucky things we've had is we've had a regulator that has understood how to sort of tread cautiously, do the right type of analysis, but more importantly, also recognizes two things. One, it is on their job to work with the industry to understand the space, to understand the details and get really educated on the infrastructure and the platforms and the ways that this could go well or not go well. But then the second thing is also to recognize that individuals are ultimately going to find ways, especially in an asset like this, that is so global in nature, has that it's kind of non-jurisdictional in many ways, that they will find ways to ultimately go, if they want to, into this space. And that recognizing that a regulated way to do so is better for society than an unregulated way, have basically chosen to be on the side of innovation and to help innovation be structurally under the regulatory frameworks. And I think that's been really positive. As you know, you've been a partner with us from day one on the launch of our ETFs in Canada. But Canada has been willing to have those conversations because you could sit down with the regulator to walk them through the changes on what you could do to create safeguards around the industry, custody being one of the most important ones there. And I think, when you look at the US, it's been frustrating because it seems like it seems like there's this notion that crypto's bad and therefore we should do everything we can to not allow it. Yet, of course, there's a lot of underlying, things like the exchanges and such, and you could always go and buy it. So the idea that people could go offshore or onshore is one thing, but it seems a little bit sort of two-faced or double-sided to sort of have this one side of you can do it, but you can't do it.
Yeah, and the problem with draconian regulation or walls around crypto is that it creates distortions and it pushes investors and consumers into the arms of players like FTX. So you're right that people are like, if they sense an opportunity, if they sense the future, they're going to find it. And it's non-jurisdictional, and everyone's got an internet connection for the most part. So they will find their way to get crypto if they want it. Right. And so it's better to do it in a thoughtfully regulated way and venues onshore, as opposed to pushing people offshore to this race to the bottom, to these venues that have no controls, no security, and can do really bad stuff like we saw with FTX. And so, I think that the idea that you're going to stop it completely is it creates these distortions and really sets up investors. And in the end of the day, what are they protecting investors from? Like making adult decisions and buying Bitcoin for the last decade, which was the best performing asset or one of them, the last decade, and is proving to be the same this decade. And so the heavy-handedness has created all of these problems. And so I completely agree with you. And the regulators in Canada, we've had great dialogue with them. We're complying, and we're applying for license and going through all of those important approvals. And I agree, they've been very open. We're very encouraged with that dialogue, and that's great. And I hope that other jurisdictions take note from that as well.
So I talked a little bit about performance, and so we've had a great year. A couple of anecdotal views. So of course, I don't know what your take is, but I get the feeling like we've seen higher quality sort of be the place that people have been navigating and gravitating towards. So Bitcoin, Ethereum have been sort of two of the areas that get a lot of attention. Of course, Bitcoin with some of the impending product launches in the US, but Solana and stuff have also seen pretty big years. Second thing is we've also seen sort of a change in, call it, institutionalization. So of course, in the past, we saw some players come and go and this and that, but this year we've got BlackRock, we've got Fidelity, we've got Franklin Templeton, we've got a number of players who actually are making pretty big commitments to the space. So I'd love to get your take on how do you see the performance sort of playing out, and are you seeing it broadly sort of within the institutional, within the retail space, and what's sort of the anecdotal perspective that you have from it?
Yeah, I mean, I think it's really important, you touched on this earlier, that there is a cycle to Bitcoin, at least there has been historically. And there's bull runs, it gets overexcited, and then there's a correction into a crypto winter. And we've seen that cycle happen a couple of times historically, but each time the highs are an order of magnitude higher, the lows end up settling where the previous high was. And so what it feels like is we're headed into a super cycle. There's a lot of catalysts on the horizon. Obviously, the Bitcoin ETFs, the Bitcoin halving, and it's really easy to lose perspective on the price. The last bull run, the highs ended in the 60s, and I remember people talking to folks who were saying in the 20s, "Am I missing out? Am I too late?" And now we're in the hopefully the end of the crypto winter, and we're settling in the 40s, which would have been a dream come true not that long ago as like the new high. And so I believe, and I think many people share the sentiment, is that the highs of the next cycle will easily break through 100K and beyond. And Cameron and I wrote a thought piece a few years ago, making the case for one Bitcoin being worth 500K. And the way we backed into that is just looking at the market cap of gold and the amount of supply in Bitcoin, and doing that simple arithmetic to say, okay, if Bitcoin's gold 2.0, then each one Bitcoin the small bull case is 500K. Bitcoin's obviously more than gold, so it could be a lot more. So I'm very optimistic in that thesis, and I think we're going to get closer to it this cycle. If not, maybe we could hit it. I mean, I think all bets are sort of off, but why this is different is that the ETFs feel like they're going to happen. It's a when, not an if.
Yeah.
And that unlocks a huge amount of capital. And so a lot of folks can't come to Gemini and open an account necessarily. Well, everyone's welcome, but a lot of folks have their net worth in a retirement savings plan like a 401k, and they can't really buy Bitcoin like the asset directly. And so they need to buy a security wrapper like an ETF product. And I came across a stat recently, but something like half of the US at least their net worth is negative. The other half that's positive, 40% of that is positive. It's held in 401ks.
Yeah.
And so a Bitcoin ETF being Greenlight unlocks all of that capital, that deluge of capital that can flood into Bitcoin that previously was gated from getting in there. And so it may be smaller checks in one way, but the aggregate is massive. And that other 10% of positive net worth individuals is probably maybe already in or has been in. But there's a huge amount of capital sitting on the sidelines. And so that's why everyone's so bullish, because like this is really an access problem.
Yeah.
I think most people believe in Bitcoin, the Gold 2.0 thesis, and we can talk more about Ethereum and what my thesis at least is for that. But that is a huge catalyst. When you see Larry Fink you can put two clips side by side. A couple of years ago, Bitcoin's bad, it's fraudsters, whatever. It sort of sounds a lot like Jamie Dimon still sounds today. And then, fast forward to not that long ago, it's Larry Fink is now Bitcoin's biggest public champion.
That's right.
And so to see that change is fascinating.
Yeah, and I think it's actually really important, because I go back to my comment at the outset to everybody, like it's important to do your own, call it a thesis. And what you have is a lot of people out there who will make these statements, lavish statements. And one is they may have a bias. In the case of JP Morgan, they're the largest currency platform in the world. So Chase is the largest trading platform for currencies. They have a bias to why crypto or Bitcoin is actually maybe a negative thing for them, because they're high agency platforms. But the second thing is, like, it's really important that you do your own research, because what I actually find really impressive and amazing is these individuals who may have been negative, 5-7 years ago, and then did the time and effort to go and learn on their own, and it actually changes. And why that's relevant is because, Larry Fink now is positive on why crypto is important. But second is that now you're going to have a organization like BlackRock and, soon to be 15 players all talking about the relevance of crypto in portfolios and how they work or don't work within the context of an overall institutional or retail investment portfolio. And so that's going to be really, really important. I think the other part is you still have people out there who, for some reason, continue to believe that crypto is worth zero. And, this is the thing that you talked about earlier about, like, as we go through these different cycles, one of the things that really kind of informs you about an asset is, as you go through a very negative cycle, does it go down? Where does it go down to? And what you've seen is these foundational prices where you have a floor that actually is important. And so both in the in the period of the COVID crisis in sort of 2020, March 2020, and in 2022, Bitcoin fell to very specific price levels. And those levels are really critical foundational levels. And as you talked about, they've built from there. And that goes to, I think, the comment around what's actually happening in the ecosystem beyond sentiment. You see more and more people buying assets and opening up wallets. You have more and more assets being tokenized in the networks and the platforms. You see more and more use cases. And these are the things that are really important, is that beyond sentiment, the actual infrastructure of the technology itself is also becoming more relevant. And that's the part that I think people forget. And so anybody who goes out there and says that Bitcoin will go to zero, I think is actually that was maybe 5-7 years ago. That's not something that you'll see going forward. I don't know what your perspective of that is, but you still see those comments out there.
Yeah, it's interesting because you do see people change their tune completely when they do the work and they dive deep. Like a Larry Fink is a great example. You almost never see people going the other way, who have done the work, who've dived deep, understand what Bitcoin is, and then say, you know what, I give up on this. It's going to zero. And I think that's super powerful. But price is one indicator, like you mentioned. And when you look at the protocol and the folks working on it, the code commits, the upgrades, how it has been evolving, you can even look at the businesses in the space. Like Gemini, we're building every day, and we have been for 18 months. And we have a greater technology stack. We have a greater offering than we did 2 years ago by a long shot. I think you can say the same thing for Coinbase. But are we, if we went out to the market and raised capital right now, would we be at our all-time high? No. And I think that price is sort of one indicator, but it misses what's happening underneath the surface. And a lot of amazing develops are happening. I can speak for obviously Gemini in the industry, and a lot of people, like a lot of folks who are fair weather, left. But the important thing is to build your thesis, obviously, do your work, build your conviction, but understand that many of the gains that have happened in this space happen over a very small amount of time. It's like a couple of days, or it's like maybe a couple of weeks total. And if you miss those days, you missed the entire decade of the game.
Yeah.
And so build your thesis, decide if you're in or out, but then have the conviction to stay there, because there's a meme, because there's a lot of tourists who came to the space. There's a meme that, it's probably, you've seen it on the web, crypto Twitter. It's like, I was really into crypto. Now I'm really into AI. And it's like, you can't just be bouncing around to the newest trend. You got to do the work, build the conviction. And when you do, I think you become more enamored with the technology, with Bitcoin. It is the first money that is purpose-built for the internet. It is money that works like your email. And when you start comparing that to fiat and gold and other forms of money, you see how broken the financial system is for most people, despite what Jamie Dimon and JP Morgan say. Well, it works for them, but most people in the world, the billions of people across the globe, are not them, are not in their positions, don't have that access. They can't roll up to a JP Morgan branch and get an account, but they do have a smartphone that's internet connected, and that means that they actually have a bank account in their hand, in their pocket, and Bitcoin is their digital gold. So there's so much to talk about philosophically of why I think this technology is the future. Money is a technology. It's been evolving for 10,000 years, and this is the latest iteration, and it's going to keep happening. And so, we've been in this for 10 years. We've been through this cycle at least a couple of times, and at this point, it just doesn't phase us at all. We're going into the halvening, this time with Bitcoin ETFs, this time with inflation, which makes the case for Bitcoin even more. The Fed looks like they might be easing on rates. Maybe they'll even consider cutting at some point next year. So there's a lot of catalysts, and all I can say is that don't write this off. I met so many people early on who found Bitcoin before myself and Cameron. We found it pretty early in 2012, and we started buying in the single digits, per Bitcoin. But I met friends who found it earlier, and they just sort of they blew it off.
Yeah.
And so they were there, but they blew it off. They didn't do the work, and so they missed it. And then they kept saying, "Oh no, like I missed it. And it's like, well, you missed it at 1,000? No, you missed it at 5,000, missed it at 10,000, missed it at 20, missed it at 40." And people are going to say the same thing at this point, but do the math on how many Bitcoin there are ever going to be. 21 million. There's 40 million millionaires in the world. So not every millionaire can even own one Bitcoin. And so the simple supply and demand, and you look at the market cap of gold, is that a single Bitcoin in our lifetime, and not that long, I believe, will be worth easily a couple $100,000, maybe $1 million. And again, like Bitcoin's a platform. It's not just digital gold. It's a protocol. And so, as you can tell, we're highly optimistic, and we have high conviction in the space, but it's played out quite well. We haven't been proven wrong yet since 2012.
So let's turn to kind of the news that's kind of driving the markets a little bit in the last couple of months, which is the SEC finally approving or likely to approve US ETFs. And look, this is an important moment. Just for everyone's perspective, the space was already seeing lots of movement off of its lows into 2023. And then of course you started to see in the last couple of months, after the Grayscale, call it court win or court case with the SEC, a expectation or an understanding that the US market was going to open up. And I think, Tyler, you talked a little bit about what it means in terms of accessing massive amounts of capital, just the frictions that it takes right now for an individual in the US to buy, crypto, and then, opening that up to all the sort of pockets of just simple broker dealer accounts and all the other things like that. But let's talk a little bit about this sort of horse race that's going to happen here. And I want, just for everyone's purposes, I think you guys filed the very first filing for a Bitcoin ETF. What was it, a decade ago? Was that, or thereabouts?
Yeah, it was in July, I want to say July 2nd or 3rd of 2013. So,
and by the way, that would have been the price of Bitcoin at that point would have been what, about $500 or so?
oh, I think it might have been quite less actually. Yeah.
Yeah. So I mean, what, like, that would have been I mean, now the infrastructure wasn't there for an ETF, and that's a really important point. But I just wanted to, I know that must be sour to some degree for you, but you've gone off, of course, and built something important.
The biggest tragedy I think about, and maybe 2013 was too early, but we ultimately got a denial in 2017, which I don't think was too early.
Yeah.
And it would be interesting to run the history again if the SEC had approved that ETF or our ETF or any other ETF at that time. I don't think you would have had FTX.
No,
I don't think you would have had the amount of fraud. And so by not approving, they created this entire mess, and hopefully they'll finally get it right in 2023. But that is that's the regret or the disappointment. Gemini, we decided that it's, like we want it to be an infrastructure play, and we're building out that piece of it. And so instead of being the ETF sponsor asset manager, our core competency is being the custodian and the service provider for those folks. So we're very happy with that position, and we haven't re-entered that race and never say never, but I think we probably
you don't have a horse
that
in the race
boat at this point. So there isn't a regret that, we could have been won this race in that way, because we're a part of it. As a provider, we're on a couple of, I think at least 3, and maybe soon to be more applications of many of the US providers. And I think a lot of them are looking at a dual custodian model. And
which
so
is what we do in Canada, which we're very, very happy with, right? Because we feel it's really important to have in this space. It's not like a normal asset that has, you have clearance platforms and things like that. If you make an error, or more importantly, if somebody comes and hacks it, there's always risk. And so you have to have, the structure behind it that is very important. And so actually multi-custodian is actually a good thing. And we have a great relationship with you and Coinbase on that basis.
Yeah, and I was just going to say that the 2 providers that are on most of these applications in most of these products in Canada and the US are ourselves and Coinbase. So it's very much a Pepsi Coke world, and we're very thrilled to play that role, and we've been doing that effectively for quite some time, in a couple of years, and with yourselves in Canada and others. Going back to the original question, it's a shame that these approval didn't happen earlier in 2017, because I think it would have prevented a lot of the issues and the pain that everybody felt in the last couple of years. But it does feel like we're finally here. And why everyone's so excited in one way is that I think January 11th is, in that time period, is the last point at which the SEC can delay statutorily. And so they have to give a go, no-go answer. I suppose if they disapprove, they could delay in a way through a little bit of an appeals process. But I think they're running out of time there. And ultimately, the courts, and I think DC spoke on the Grayscale case, the SEC didn't appeal it. If they were really trying to fight this and hold off ETFs, they probably would have. So if you look at all of the signs and read the tea leaves, and the fact that Chairman Gensler doesn't say that Bitcoin is a security. They've been very clear that the one thing the SEC has been clear on is that Bitcoin is not a security. It seems like all signs point to an approval at some point in Q1 next year, which, as we mentioned earlier, will be a huge catalyst of sorts, because it will allow folks to get in through different vehicles. And many people, whether it's a large pension fund or it's a retirement savings plan for an individual, they need a securitized wrapping of Bitcoin. They can't hold a bar of gold. They need to hold gold through an ETF. They can't hold a digital bar of Bitcoin. They need to hold a security wrapper of it. And so this is really opening up the floodgates to that, and that can't be underestimated. And it's the first time that traditional finance is really converging with this new world of decentralized finance. We've all been trying. We've had the conversations. I'm sure Coinbase has as well with all of the traditional finance brokers and banks and whatnot. But it's been so hard to integrate and actually get us all together. And I think that this will be the first time where the old world of finance and money actually meets this new frontier.
Well, and I would just add, so I think that's a really important point. And I think, well, I would also add that most of the assets in the United States are, and globally, are advised assets. So what it is, most of the users of crypto today have been individuals who have gone through their own setup of their own wallets or their own accounts at a broker exchange. But the advised industry actually has, for the most part, not utilized crypto in their portfolios, mainly because utilization tools like ETFs hadn't been available in the United States. And Canada, of course, we've seen that. And I think that this will allow for the advised industry to now start to really look at a thesis of how crypto could be a part of their portfolios. And frankly, that will happen because, one, clients are asking for it. The number of high net worth individuals who have crypto on the side of their accounts because they can't get it through their traditional broker dealer account is really quite high. And I think you're going to see that wanting to come into the main core part of a portfolio construction. I think the other thing is, look, I don't know if we're going to see this euphoric, exciting, massive sort of demand in the first couple of weeks and months post-launch. But I do think that, to your point, we're now going to have, theoretically 13 new issuers walking around talking about how crypto belongs or works within the construct of a portfolio, both for retail and institutional, both advised and unadvised. And you're going to see this become a foundational platform, going back to the earlier thing we talked about, which is, the sentiment is one thing, but the foundations of utilization are growing. And so that's the thing that really drives that sort of next stage of this cycle as one component. I don't know where I'd love to get your perspective of also coming into sort of through 2023 and into 2024. What's the sort of institutional market, advisor market kind of change that you've seen in sentiment? And, what's sort of the anecdotal perspective that you're getting within your business, which actually would open up direct custody accounts and stuff for many of these organizations?
Yeah, well, the sentiment is very positive and folks are very excited. We've seen, just anecdotally, a lot of institutional clients come back. They took a break from crypto, during the whole turmoil with FTX and the crypto winter. And so they've come back. So there's a lot of new excitement. But I think your point is really interesting, is about the investment advisor platforms. I think there's an analogy here where if you're a hedge fund manager of some certain caliber, that you get on the platform, so to speak, of asset allocators. It's like getting on the shelves in Walmart if you have some sort of consumer packaged good, and there's like the positioning on the end caps of shelves or right near the register.
That's right.
For a decade, Bitcoin can't get on the shelves. It can't get on the platform. It's not near the register. When you walk into Walmart, you can't buy it. And so all of a sudden, when these ETFs go live, what does that mean? It's like a hedge fund manager being on the platform and then CalPERS can literally allocate to them. Or, all of these folks who use these investment advisor platforms for BlackRock, they say, they toggle a switch and they say, okay, what's your risk appetite, or how do you want to allocate your capital? And Bitcoin's there. It's a choice, or it's under the hood and you didn't even know it, but you've allocated to it based on your return, your goals.
Yeah.
And so I think that is the way to look at it, and that is the excitement. It does feel like we are back.
Yeah.
And it's not just the Bitcoin we are back. It feels like the crypto market is back.
Yeah.
The spring is around the corner. We talk about crypto winter, but we say winter's a season and this too shall pass.
Yeah.
It feels like spring is around the corner, and then all of a sudden after spring, there's summer. So that is the way I'm looking at it. There's tremendous excitement on Wall Street. There's tremendous excitement in market makers. They're coming back, and there's a preparation and there's an anticipation for these ETFs getting greenlit. And we're seeing people come back and trade again, test the pipes, and just get ready, get their ducks in a row, get really familiar with the platform, so they can create, redeem baskets, and obviously manage their positions and whatnot on the exchange. So if we were having this conversation 6 months ago, that would not have been the case. Yeah. I'd say we're still in the depth of crypto winter. Not much has changed since 12 or 18 months ago when things started to blow up. But now it feels like a lot of this is behind us. People are looking ahead, and they're really excited with the catalysts of, as we've mentioned, with the ETFs, and obviously the halvening. And I think that the halvenings, for people who don't know, it just means that
let's talk about that. Actually, let's go through the halvening, and just for everyone's purposes, maybe just walk through like what's actually happening in April or thereabouts, and why it's relevant, for Bitcoin.
Yeah, sure. So the amount of Bitcoin is fixed, and I always love to dwell on this point because gold is scarce; it's not fixed. And so if the price of gold goes up, mining becomes profitable. People find more gold. As technology improves, people can find more gold as well. It's sort of like fracking unlocked more energy in oil, and whatnot. And so but you can never unlock more than 21 million Bitcoin. But the supply schedule is such that every 4 years, that amount halves. So it's still going to end up at the same spot of there's only 21 million Bitcoin ever released. But the amount that's being minted every 10 minutes or so will cut in half. And people, there's been this age-old argument of well, that's priced in with the market. It's always priced in, and people know it's coming, and therefore it won't have much price action. But historically speaking, it's always been a big catalyst. It's never been fully priced in. I don't know exactly why, if the market's not efficient enough. But if there's only, let's say, 25 Bitcoin being minted every 10 minutes, the miners will be minting, or will unlock, that will go down to 12 and a half. And the miners are the ones who are unlocking this. This is a reward they win for auditing the blockchain and making sure that I don't spend my Bitcoin twice. They create the digital scarcity, and that's their reward. But when they do that, when they unlock the reward every 10 minutes, they usually sell that to get capital to then buy more mining rigs, because it's an arms race, and the technology is always improving. And so they're always plowing back some of their rewards into their mining infrastructure to win the next award. And so all of a sudden, the sell pressure on the Bitcoin marketplace is going to reduce by half. Miners will just have less coin. They'll win less coin and be selling less coin. And that usually always, it's just basic supply and demand that usually creates some upward price action. It certainly doesn't depress the price because there's just less sell pressure. But the other thing, it's kind of an X factor that always happens, is that there seems to be like adjacent new aspects that new concepts that become a thing, and sort of a Cambrian explosion of experimentation and innovation. And so DeFi started happening around the last halving. You had NFTs. Before that, in 2017, 2018, there was ICOs, the ICO craze, the idea that you can build a token on top of Ethereum, and that created a lot of bull runs. So there's a Cambrian explosion of innovation and excitement that always seems to happen right around or just after the Bitcoin halving, which you could say is maybe not related, but it's at least deeply adjacent to, and it seems to keep happening. And so, of course, the halving is a catalyst for Bitcoin, but it seems to be a catalyst for the entire industry.
Yeah. Well, I think that's extremely important. So for everyone's benefit, I mean, this is going to have a disinflationary effect. It happens every 4 years. This is going to be a year that it's going to occur in the sort of first half of the 2024. But more importantly, it's also going to, it's generally very positive for price, it's foundational price movement. And so you sort of couple that with ETF and what's happening around the ecosystem. It's really exciting. You mentioned, Tyler, earlier, you have a thesis on Ether. I'd love to, let's spend some time on Ether. We talked a lot about Bitcoin. And I think for most of the people online, it's really important first to start with like Bitcoin and Ether. They get talked about all the time together. They move a lot in price movement together, but they are very, very different in terms of what's the driving force for their long-term thesis. Bitcoin has, this, call it fixed supply and demand, the gold-like principles. And when you start thinking about the principle of economic growth, the global population growth and where they are going to transact in such, what probability would you apply to Bitcoin becoming one of the most interesting non-jurisdictional currencies in the world with a fixed supply? But when you look at Ethereum, which is non-fixed supply, and has a foundational utility and infrastructure around what you're building on DeFi and other types of principal stablecoins and such on top. I'd love to get your perspective on why you like Ethereum differently, or why you are excited about Ethereum versus Bitcoin as you go into the year ahead.
Mm-hmm. Yeah, so Ethereum is definitely not as fixed as Bitcoin. Nothing is. But its supply story is pretty scarce, and that's probably beyond the scope of this conversation. But the way to analogize Bitcoin, and we talked about this before, is digital gold or gold 2.0, and you can think of Ether as digital oil. And so if you think about all of the cloud computing, so Amazon AWS, Microsoft Azure, Google Cloud, if there was a token that allowed you to purchase compute so you could run your applications on top of those cloud providers, that token would be Ether. And so Ethereum is a virtual cloud machine, if you will. It's like Amazon, Microsoft, and Google combined. And it's where you run your decentralized application on it. But unlike Amazon, you can't put your credit card in and open an account and pay them for their computational resources or storage. The Ethereum cloud computer, if you will, requires Ether. So it's a very valuable, it's the substrate, it's the fuel, it's the oil of the largest virtual computer in the world. And that's what excites me. It's very different. Bitcoin's very much the gold story, the fixed supply, the hard sound money. But Ether, the Ethereum network, is where people will create decentralized Twitter, decentralized Uber, decentralized Facebook. And Ether is the oil, the fuel that will make that happen.
Well, and I'd add to that is that, like, one of the nice things that Ether's done as well is, as you talked about, from a supply perspective, they moved to proof of stake as a form of mining, right? And so what that means is that if you own Ether, you are ultimately able to become the mining, the validators of the transaction and the platform, and you participate in the value of the ecosystem's growth. So revenue growth, you get a piece of that. And as the platform grows and you are an owner and a staker, you ultimately are generating a share of the overall profit. It's a very, very unique kind of environment. And when you think about this principle of like a well-governed, well-structured platform, and then you've got this year coming in, you've got some upgrades in terms of the Cancun fork, which will actually drive prices of transactions down below a penny per transaction, which will, I think, in many ways drive Ethereum to call it a more mainstream uses, while platform and layer 2 type of technologies are growing, stablecoin utilization is expanding massively, all of this really exciting stuff that will increase the value of, I think, the network itself. So I get so excited about it. I think just a very simple one is, I'd love to get your take on stablecoin utilization and what you're seeing on, call it these layer 2, call it stablecoin platforms, and how you sort of see that evolving over the next decade, a number of years.
Yeah, and just the final point is that, owning Ether is a really simple way to index the entire Ethereum network. So it's like owning land in Manhattan hundreds of years ago. All of the skyscrapers, all of that incredible activity that will be built on top of it, you become the beneficiary. So instead of picking which building or which entrepreneur or which real estate developer, just by owning the substrate and the land of Manhattan, you benefit by the entire ecosystem that's being built on top of it. So, Ether is the native L1, but all these L2s, all these other projects, as the entire stack, will just own the easy way to get in is just to own the index, the underlying native fuel that everything requires in the Ethereum ecosystem. So stablecoins are really, really interesting, really fascinating, because they are basically taking old world fiat money and giving it a cryptographic form factor so that it actually works like your email. It's sort of like a wrapper. It's like, how do I get government fiat money onto the blockchain? So, I would make the case that you don't want to spend your Bitcoin. You don't want to sell your Amazon stock, because these are great assets that appreciate. You want to spend your money that's depreciating, your government fiat money. And so, oh no, that's not on the blockchain. So how do I, transact and use a medium of exchange? Stablecoins provide that linkage. They bring fiat onto the blockchain so that it works 24/7, 365. It's truly global. It goes everywhere the internet will go. And so really important, but there's also a lot of projects that are algorithmic stablecoins that aren't a wrapping of the fiat form factor. We have the Gemini dollar at Gemini, but the dollars are held in bank accounts and the token is issued. So it's kind of mixing, the new frontier of DeFi and traditional finance. But they've been super important for folks who want to, move money around, but also not really store their value in, lifelong appreciating access like Bitcoin and Ether. But maybe, okay, now I need to trade, I need to buy something, then you transfer some of that into a stable coin, but you leave the majority of your assets, just like in traditional finance. You don't really touch your gold holdings, you don't touch your stocks that you think are going to go up, and you keep some cash on the sidelines. And that's what stablecoins are in blockchain.
Yeah, and I couldn't agree more. And I think you think about the next layer of how the expansion of utilization. It's just, you've seen this amazing explosion of utilization of stablecoins. And I think you're going to see that grow. And it's one of the things I'm really excited about. Maybe just before we get off and we're at an hour here, I just wanted to maybe ask you one last question. You've had a long-term thesis in the space. You've talked about being, really excited about crypto, Bitcoin for over 11 years, 12 years now. When you think about what energizes you about the next, sort of next 10 years, what's one of the most exciting things you're interested in right now that's driving the next stage of your thesis?
Yeah, it's a great question. I think the most exciting point is that so much of the promise that we know is going to happen hasn't happened. It's still really early. The most of the world is not on a blockchain. Most of finance is in traditional finance. Most of applications are still run on Web 2.0 and owned by a few companies. Web 3 hasn't really arrived. We see glimpses of it, but a decentralized internet, decentralized finance, decentralized money, that future is still not, I mean, it's here in glimpses, right? If you're intrepid enough to go on the frontier, but it doesn't underpin our daily life. There was, conversations like, will we really transact on the internet? Will people really buy their plane tickets on the internet? That'll never happen. And all of a sudden, it's like, wait, how do I live without Amazon Prime and all of these services and applications? So it is still so early, and that's what excites me. There's so much unfinished business that needs to be finished and accomplished over the next decade. And so if you think you're late to the game, it's just beginning. Obviously, another convergence that's really interesting and that's very, very relevant is AI. Yeah. AI has definitely arrived on some level. And we've been talking about this for a while, is that the AI can't get a bank account with JP Morgan. It's just not going to, right? But it can plug into a protocol like Bitcoin. And so crypto is really money for AI and machines. And it's going to be fascinating to see that convergence over the next decade as well. So it feels like everything, all of the pieces are coming into place. The stage is being set. And I'm really excited to finally accomplish, what we talked about and dreamed about for the first decade over the next decade and then some. Really the promise of crypto, the financial inclusion aspect, the really changing and evolving money, Wall Street, and finance as we know it. That is what keeps me going. Is I just don't feel like we're done.
Yeah.
And I feel like there's decades of unfinished business ahead of us.
I think that's well said. And I would just add that, like, what's amazing is that through 2023, you're starting to see real efforts and execution on the legitimization of payments and crypto as a core payments utility. You've seen really important elements around platform of TradFi to DeFi and the principles of all of the foundational alignment. And then, as you say, when you start thinking about nativity of what crypto is in a digital society, and digital society being whether that be commerce in digital nature or AI, it becomes so aligned to that future state. It gets exciting. And the last thing I'd say, what really just continues to drive me is that when I think about sort of global population and growth, you think about, we have 8 billion people going to 12, but about, 3 of those 4 billion that we're going to grow from are going to come from Africa. Another billion is going to come from Southeast Asia, non-China. Those nothing in developed economies like Europe and US and Canada. Those regions, are going to non-jurisdictional FX. They're not going to be in the traditional fiat models. And sure, the US dollar, sure, the euro, whatever, you want to put on those probabilities of being dominant currencies. But what probability will you put onto a non-jurisdictional FX currency like Bitcoin and or stable coins that will be built in the future? And you have to put that sort of leading probability in those right now. They may not win 100%, but there's a high probability that they do have a shot to win, and it's probably the leading opportunity to win. So I get excited about that. And so, you know, we have to really look at this as an exciting space to be a part of. I believe that every individual should have some allocation, especially when you're in a high net worth family, should have some allocation to this space, and Bitcoin and Ether being the two that are most relevant. Tyler, this has been awesome. Thank you very much for taking the time with us. And we had a number of questions online. I think the team was basically answering them on the Q&A chat. And we ask if anyone has any further questions, please reach out to us at Purpose. We're happy to answer them. And we're excited about the next couple of months. We're excited about the next couple of years ahead. And thank you very much. And great partnership to be with Gemini and what you guys have been doing with us for the last number of years.
Thanks, Sam. Appreciate the conversation. Cheers.
Happy holidays, everybody, and Happy New Year to everyone. Thank you.
Likewise.